You've used money your entire life. You've earned it, spent it, stressed about it at 2 a.m. But here's the thing. Nobody ever told you how it actually works. Not your parents, not your school, not your bank, and that's not an accident. Because once you understand how the US money system really operates, you start asking questions that a lot of powerful people would rather you didn't. So in the next 10 minutes, I'm going to explain the entire US money system. From how dollars are actually created, to why inflation keeps making you poorer, to what the Federal Reserve actually does with your economy, in a way that finally makes sense. Stick around. This is the video your high school economics class refused to be. Let's start at the very beginning. What even is a dollar? Go grab one, or just picture it. It says Federal Reserve note right at the top, not United States dollar, not government money. A Federal Reserve note. A note is a promise. A debt instrument, which means every single dollar in your wallet, is technically a piece of paper backed by trust, not gold, not silver, not anything physical. Up until 1971, US dollars were backed by gold. You could literally trade your dollars in for gold. Then President Nixon said, "We're not doing that anymore." And just like that, the dollar became what's called fiat currency. Fiat is Latin for "let it be done." Basically, this is money because we said so, and before you call that a scam, it actually works, as long as everyone agrees to play the game. The entire global economy runs on this system, but here's where it gets interesting. Where does new money actually come from? Most people think money is printed by the government and then handed out. That's kind of true, but mostly wrong. Here's the real answer. Most money in the US is created by commercial banks, like Chase, like Wells Fargo, like your local credit union. Here's how. When you walk into a bank and take out a $10,000 loan, that bank doesn't go into a vault and pull out $10,000 in cash. It types a number into a computer, and boom, $10,000 that didn't exist before now exists. This is called fractional reserve banking. Banks only have to keep a small fraction of your deposits in reserve. They're allowed to loan out the rest multiple times over. So $1,000 deposit can technically create $9,000 in new loans, which creates $9,000 in new money. I know, it sounds fake, but it's not. The Bank of England literally published a paper in 2014 admitting this. They said, and I'm paraphrasing here, most money in the modern economy is created by commercial banks making loans. So your bank, not just storing your money, it's creating money every time it lends. Now, this whole system needs a referee, someone to set the rules, someone to control how much money gets created. Enter the Fed. The Federal Reserve. You've heard of it. You probably know it does something important, but most people couldn't tell you what it actually is. Let me break it down fast. The Federal Reserve, or the Fed, was created in 1913. It's the central bank of the United States. And here's the weird part. It's not exactly a government agency. It's not exactly a private bank either. It's this strange hybrid, a federally chartered institution with private member banks and a board appointed by the president. Basically, it's complicated, which is why they'd prefer you not think about it. So, what does the Fed actually do? Three main things. 1. It sets interest rates, specifically the federal funds rate, the rate banks charge each other to borrow money overnight. When the Fed raises this rate, borrowing gets expensive. Mortgages, car loans, credit cards, all of it goes up. The goal, slow down spending, cool off inflation. When it cuts rates, borrowing gets cheap, economy speeds up, people spend more, businesses grow. This one dial, the interest rate, affects almost every financial decision you make. 2. It acts as a lender of last resort. If a big bank is failing and the whole financial system is at risk, the Fed can lend it money. We saw this in 2008. We saw it again in 2020. The Fed stepped in with trillions of dollars. Where does that money come from? The Fed can basically create it, which brings us to number 3. It conducts what's called open market operations, meaning it buys and sells government bonds to inject or remove money from the economy. When the Fed buys bonds, it creates new money and pumps it into the system. This is called quantitative easing, or QE. You heard a lot about this after 2008 and again after 2020. When the Fed sells bonds, it pulls money out, tightens the system, slows things down. The Fed is basically the DJ of the US economy. It's controlling the volume, trying to keep everything from going too loud or falling completely silent. The problem, getting that balance right, is really hard, and when they get it wrong, you feel it. Okay, so now you know money can be created. You know the Fed controls how much of it flows around. So here's the natural next question. If they can just create money, why doesn't everyone have enough? And more importantly, why does everything keep getting more expensive? That's inflation. And it's not random. Inflation is what happens when there's more money chasing the same amount of stuff. Think of it this way. You've got 10 people and 10 pizzas, one pizza each. Simple. Now you print $10 more and give everyone more money. But there are still only 10 pizzas. Now those pizzas can charge more. Because everyone has more money, prices go up. Your money buys less. That's inflation in one pizza metaphor. Now here's something they really don't advertise. The Fed actually targets 2% inflation per year on purpose. By design. Why would you want prices to go up? A little inflation encourages spending, because if you know something will cost more next year, you buy it now. It also makes debts easier to pay off over time. But here's the part nobody talks about. Inflation hits people differently. If you own assets, stocks, real estate, a business, inflation usually raises the value of what you own. You get richer, in nominal terms. But if you're just holding cash, every year your savings are worth a little less. The bank paying you 0.01% interest while inflation runs at 4%. You're losing money while it just sits there. This is why wealthy people don't just hold cash. They hold assets. And it's why the financial system, almost by design, rewards people who already have money and slowly erodes the position of people who don't. I'm not saying it's a conspiracy. I'm saying it's a feature. That happens to look a lot like a bug when you're on the wrong side of it. You've probably heard that the US is in debt, like a lot of debt, over $34 trillion as of 2024, and climbing. And every few years, there's this huge, dramatic political fight about the debt ceiling, whether to let the government borrow even more. Should you care about this? Yes and no. Let me explain. First, who does the US actually owe this money to? Surprise, mostly itself. About 21 trillion of that debt is owned by US government agencies and the Federal Reserve. The rest is owed to investors, American citizens, pension funds, foreign governments. China owns about $800 billion of it, which sounds scary, but is actually less than 3% of the total. Second, can the US go bankrupt? Technically, no. Not in the traditional sense, because the US borrows in its own currency, the dollar, and it controls the dollar. It can always create more dollars to pay off dollar-denominated debt. The actual risk isn't bankruptcy. It's inflation. If you print too many dollars to pay debt, those dollars lose value, which, as we just covered, hurts regular people most. The national debt is real. It matters in the long run, but the people screaming about it on TV usually aren't worried about your grocery bill. They're worried about very different things. Okay, you've just had a crash course in how the entire US money system works. Let me give you the 5 takeaways that actually affect your life. 1. Money is created by debt, which means the system needs borrowing to function. So don't be ashamed of using it strategically. Good debt at low rates for assets that grow. That's how the game is played. 2. The Fed controls borrowing costs. When they hike rates, your mortgage, car loan, and credit card get more expensive. When they cut rates, that's your window to refinance, borrow cheap, invest aggressively. 3. Inflation is the silent tax. Sitting in cash long-term is losing money slowly. You don't have to be a genius investor, but you do have to be somewhere in assets. Index funds, I-bonds, real estate, something. 4. The system rewards asset owners. The earlier you start acquiring assets, even small ones, the more the system starts working for you, instead of against you. And 5. Understanding this stuff is a power move. Most people float through their financial lives completely unaware of how the system works. You don't have to anymore. That's the whole point of this channel. If this video made something click that nobody ever explained to you before, hit subscribe, because that's literally all we do here. Finance is complicated on purpose. We're going to keep making it simple. Next week, we're breaking down how credit scores actually work and the one thing you might be doing right now that's silently wrecking yours. You don't want to miss that one. See you then.